Guys, welcome to the show. 4 o'clock today, we're going to have some big earnings results. So you must subscribe to the channel right now and watch for our videos at 4 o'clock. It's Apple, Intel, and Amazon. Big results today. Now we're going to do Shopify, Southwest, McDonald's, and Align Technologies, which is the maker of Invisalign, which Mo and my brother upstairs have used. So first off, Shopify. Earnings per share, they lost 2 cents, but it beat expectations of a 7-cent loss. Revenue came in at $1.37 billion, which beat estimates of $1.34. This is their press release, okay? Now, total revenue increased 22% to $1.4 billion compared to prior year. 3-year basis, the total revenue CAGR, which is compounded annual growth rate, was 52% per year. That's a lot. Monthly recurring revenue increased 8% to $107 million. This is what I like to see, though. Gross merchandise value increased 11% to $46.2 billion. This means Shopify runs credit cards, right? They run credit cards for online purchases. The online purchases were a total of $46.2 billion that was run through their system. That's a good way to look at all the credit card companies to see what are they actually running through their system. And I like this because to me, as we saw today with GDP grew 2.6%, which beat expectations. So are we out of this pseudo recession we talked about? We don't know, but that definitely is good news. Now, next company, Southwest. Guys, Southwest, full disclosure, I have puts on Southwest. I love Southwest. It's the only airline I like. I'm just waiting for the right price to buy it at. Earnings per share, they did 50 cents, which beat 44-cent estimate, but revenue came in at $6.2 billion versus $6.32. However, on their press release, they did announce, which is true, record third quarter operating revenues. This is still a record of $6.2 billion. Net income of $277 million, and net income excluding special items of $316 million or 50 cents per share. Liquidity of $14.7 billion, well in excess of debt outstanding of $8.7 billion. Now, I want to take you to our software, and we're going to do a little analysis on Southwest.
So not only was this a record, but they had a record summer demand too.
Good.
So it's just record on record.
Record on record on record on record. Okay. Exactly. So the last 12 months, not including this quarter they just reported, $21.15 billion in revenue. And if you look, their record of all time was $22.34 right before COVID. So guys, they're getting back to pre-COVID levels. Now, profitability, quarterly profitability, their record ever, not ever, but let's see, let's go back before COVID. Could be ever. Nope, not quite ever, not even close. But the point is, they're getting very close to back to operating levels. That's what we want to see. Southwest's big thing, which I love about them, they hedge their fuel very well, and they focus on regional routes, and they're the only airline before COVID to had 48 years in a row of profitability. They also stick to the same planes. Their goal is, listen, we want to dominate one plane, the 737. This is it for us. Before COVID, during COVID, I did a lot of research I read their 10K on Southwest. I love the fact that they made $2.3 billion or something in the previous year. That included a $840 million loss because of the 737 MAX issue, which in that time has been hopefully resolved. The planes are back up and running, so I think it's going to help out the company. Now, balance sheet. As they talked about.
Didn't it take COVID to give them their first losing year ever?
Yes, correct. That's what I was meaning about that. All right, so go look at the 8 pillars. Guys, it's terrible. Why? Well, the company the last few years have been very, very tough. PE's low, and it's not even stable yet. Like in the last year, what are they showing for profit? $1 billion when they were showing 2-point-some billion previously. So this company is pretty interesting. Low 5-year return on invested capital, but that 5-year return on invested capital is based on free cash flow. And free cash flow is down a lot because of the last few years. Revenue is down. Listen, the bottom line is I look at these X's and go, Like I look at this company going, okay, let's just go to Stock Analyzer tool and put it right in right now.
Kind of the opposite. When you had crazy COVID numbers on some companies, this is crazy to the downside.
Correct.
Taper it the same way.
Correct. So revenue growth for Southwest. I'm just going to let's look at analyst estimates first on our software. Oh, wow. Look at this, Mo. they're expected to do $8 a share in profit in 2026.
Wow.
If you apply a 15 multiple to that, and they do hit it, if they do hit it, that's a $120 stock. It's currently at $35. This could be a multi-bagger if all these analysts turn out to be correct. Revenue growth. They're expecting $24 billion this year, and in 5 years, $32 billion. All right, so let's go to our stock analyzer tool. Revenue growth. I'm going to do, oh shoot, I forgot to look at the percentage here. Mid-high single digits.
Yeah.
So I'm going to go with 2, 5, and 8. Profit margin, I'm going to focus on the 10-year profit margin, not the 1 year, the 5 year, because it includes a lot of COVID. I'm going to do 6, 8, and 10. And I think before COVID, they were doing 10 to 15% profit margin. So it might still be low. Actually, I'm going to do 7, 9, and 11.
Okay. I'll stick with 6, 8, and 10 and see
okay.
what it comes out at.
I'm going to do 7, 9, 11 for free cash flow. Now for PE, I'm going to do 13, 14.5, and 16. And the same with our price to free cash flow. 13's low. However, with this growth rate, things like that, it kind of is a little poopy here. Desired annual return, 12, 13.5, and 12, 13, 14. Now, I hit the analyze button. Okay, right here, guys. A low price of 26, a high price of 61, a middle price of 40. So if you believe my middle assumptions and you go in there and verify it, you're probably buying the stock right now because it's going to give you, according to this, a 13% return based on net present value if you buy it for $41. Now, for me, I have a lot of puts on it. I don't think I own any shares right now. I have to double check. But I like the company. I personally believe it's great. I think the airline industry is a very tough industry. That's the hardest thing about this company. I just hope that Southwest doesn't get these grandiose ideas of we need to be the biggest airplane. We need to be the biggest airline in the world. That's when airlines get in trouble.
They haven't done it in the past. They haven't even sniffed that idea in the past.
Correct.
So hopefully they stick with that.
Hopefully they're like the crossroads group of the airline. Like we just want to stay in our lane and get good returns on our money.
Something I talked about on the morning show. You don't need to be the biggest and the best in your industry to be a good company to invest in.
In fact, when you start to try to become the biggest and best overall company, it usually has problems. All right. So McDonald's. Let's go to McDonald's. Guys, McDonald's is crushing it. Global comparable sales increased 10%. U.S. comparable sales increased more than 6%, marking the 9th consecutive quarter of comparable sales. Now, I'm going to acknowledge, every morning, I get a hash brown and I get a large Diet Coke light ice at McDonald's. It costs me $3.16. I am the reason for the 6% comparable sales. Okay? It's purely me. Every time I go on a trip, I go to McDonald's. I was in London in September and Italy afterwards. I went to McDonald's in both countries.
You're responsible for this too.
International same-store sales.
8.5 versus 5.6.
So it's funny. There's a little story there. I went to the London McDonald's. Was it London McDonald's? Yeah, I went to London McDonald's right down the street from not the London. There's tons of McDonald's in London. And I wanted to take a picture on Instagram for my Instagram for the followers on YouTube who follow us on Instagram. Follow us right here, by the way. And I started to take a video, and the manager comes out and gets really mad at me. He goes, "You can't take a video here unless you ask." I'm like, "Oh, sorry about that. Can I take a video?" He goes, "Yes, but don't show the workers." I was like, "Okay." So I don't know if it's a London thing. I don't know if there's like a law about it. I felt really bad, and I was like taken aback. But either way, London and Italy, phenomenal McDonald's. I highly recommend it. Just like that. Okay. Digital system. I don't know what that means. Guys, global sales increased 9.5%. I mean, McDonald's is the jam. So let's just see. Is it a reasonable price to pay? Well, we're not doing that actually, are we? Let's go look at the McDonald's on our software.
Yeah, just take a quick look.
Okay, why don't you do that, Mo? Well, I look at McDonald's. You put it in the stock analyzer tool.
Okay, I'll throw it in here real quick.
I'll show you what analyst estimates are. Analyst estimates for 4 or 5 years are 5 to 7% growth. Revenue estimates are 2 to 4%.
2 to 4. Okay.
Let's look at the 8 pillars here. So guys, in the 8 pillars, high PE, high price of free cash flow, decrease in shares outstanding. I don't like that when there's a high PE and high price of free cash flow. A lot of debt, not as concerning for me on McDonald's. It probably is a company that can really support that debt. Revenue growth. Now remember, this revenue is, I believe a lot of it is the royalties. It's not McDonald's owning corporate stores. It's royalties from their franchisees. So the thing is, EPS was $2.68, which beat $2.57, and revenue was $5.87 billion, which beat $5.7 billion. So That is why they're up $3.30 after in the open. So, Bo, stock analyzer tool, show us.
So revenue growth, I put in 1, 2.5, and 4. Profit margin 21, 22, 23. Same for free cash flow. PE 13, 15, 17. 13 can be argued that it's low. 17 can be argued that it's high. Desired annual return, McDonald's isn't going anywhere. 12, 13, and 14 are good for my margin of safety. $70 to $95.
It's at 265.
It's at 265, and I think that's probably consistent looking at the PE and the price to free cash flow.
Guys, it's just math. And I know that sounds low. You sit there and say, oh my God, McDonald's isn't going to go down from 265 to maybe not. But you have to at some point pick a point where you realize that when you buy a business, which is what you're doing, you buy stock. When you buy a business, you are buying a stream of cash flow. And if you overpay for that cash flow, your returns go down.
Align Technologies came in down 19% this morning. This is Invisalign. It's a great product. I know a lot of people that have used it. A lot of people are happy
You used
with
it.
I used it.
How'd you like it?
Twice. I thought it was great. I still sleep with the trays every night.
Do you every night?
Yeah.
Wow.
Mikey uses them, Paul's brother. My dad used them. My brother used them. Everybody used them. $1.36 earnings per share versus $2.21. 890 million versus 973 million in revenue. So they missed on that. Now, this was one of those companies that let's look at the 5-year chart. I mean, look at this. This thing went bonkers during COVID, and then it came right back down. It was a great time to use. That's when I used it. It was like, well, I'm sitting at home all day. I don't have to really go anywhere. And when I go to the office, nobody's there. So it was a good time to use it. I don't know. Paul, you liked this company in the past.
I've looked at it because I look at Invisalign and I hear what people say about it. And I hear the people who've used it, and it's really interesting to me. Like I like it when things are disruptive, like Kathy Wood. To me, this is a better solution to.
This one is actually pretty disruptive.
Actually, it is. That's what I mean.
Yeah.
But this one's actually a better version of braces.
Yeah.
Right. So I look at it now. I will say, for kids,
no, it's not going to work
because kids are going to sit there and they're going to forget using it. They're going to keep it out. I think it's good for adults.
Probably have to be, if I had to guess, 16 plus to be responsible enough to brush and keep putting them in and.
Yeah.
Yeah.
Oh, even then, I think you have to be an adult.
Even then, you're probably a little self-conscious, so probably after college.
So I have a cousin. I'm not going to mention his name. Great guy. And, once we were talking about things, and he said, when I was a kid, I needed braces really bad. And he still does. He'd be a perfect candidate for Invisalign because, I was not going to have braces. Absolutely refused it. My parents are getting your brace. Nope, not going to happen. Didn't do it. He's the perfect guy to do Invisalign right now. Mm-hmm. Why? Because he's now in his 40s. He's like, okay, that's the kind of person that should be using it.
That's why I did it. I wish that my parents wanted to get me braces. I refused. And in retrospect, I wish I wouldn't have refused because it would have just solved the issues. But then I did this. There's a solution.
Yeah. So
good solution.
Did you do, so what's analyst estimates saying for Invisalign?
Analysts are saying on earnings per share side, $8.71 to $18.17 in 2026.
Wow.
Revenue, mid-teens, low mid-teens, I would say, with the exception of that.
You might want to delete your little chart there.
Oh, yeah. Well, that's where Invisalign is going right
now.
So, yeah, I mean, do you want to put it in stock analyzer?
Yeah, put it in stock analyzer. Now, here's the thing. Is this a luxury item?
I do think it is.
Yeah, it is.
I don't know how insurance goes about covering this. That one I don't know.
Because you paid out of pocket.
Correct. Because my insurance didn't cover it. So
right.
Okay, let's put it in stock analyzer real quick. Okay, I'm gonna go, man. I'll go 7, 10, and 13. Profit margin, man, that's all over the place. We'll go 16. 19, 22. Free cash flow, maybe I'll do the same. And this almost proves that it's a not so much a luxury item, but almost it's a self-conscious item. I don't know.
Okay.
Current price 185.
185. Sorry, not 175. Yeah, 185.
127 to 219.
Invisalign's a company that's interesting to me. What's the market cap of Invisalign? Because I'm worried about just being able to sell options on it along the way.
$14 billion.
Okay, so I might have decent options. So one of the things I do, guys, as an investor is I have my holdings of stocks, and then I sell covered calls on them to generate income. All right? I'm not trying to generate a ton. Between 2 and, it's a very wide range, 2 and 6% extra a year. But the point is, if it's extra, I'm good with that because it's extra money.
Yep.
And I can use short-term losses to offset that income and essentially pay no taxes on my covered call income. Okay, we're good. So if you've used this product, if you have people, I mean, the balance sheet's pretty good. What's the balance sheet look like? So cash on hand is what? 900 million.
Yep.
What's total debt?
Total debt is
1 billion.
1 billion, yeah.
That's all. No, sorry. 2.2 billion.
Yep.
All right. So decent liquidity there. What's the 10-year? What's the, let's go to the 8 pillars here. Did you do that already?
Did not.
Okay. Let's go to
I
the
would
8 pillars.
imagine it's pretty good.
Wow.
Yeah.
All right. But again, so the free cash flow and the earnings are very different, right?
Yeah.
19 versus 30.
Yeah.
So it means they're showing more earnings than free cash flow. That's something I'd want to understand. So guys, I need you to do one thing. If you like this, don't forget 4 o'clock today, Amazon, Apple, Intel. Every single day we do earnings results this week. It's a big earnings week. And apart from that, we still do 2 or 3 videos a day. So you must subscribe. Please subscribe right now. Thank you very much.